Good afternoon. We at the American Stock Exchange, together with Donaldson, Lufkin, and Generette, Merrill Lynch, and Smith Barney, are proud to be sharing this great adventure with you. I think we are demonstrating that our nations can cooperate to their mutual advantage. Every year before these sessions get underway, one of the first questions that I'm asked by overseas visitors is, what is the thinking of the Federal Reserve Board? This year I was able to respond that we would soon hear the board's viewpoint firsthand from its vice chairman, Manuel Johnson. When Dr. Johnson first became a board member in February of 1986, some thought that his strong economic views would rile the waters during difficult decision-making. But he quickly showed that he would avoid personal feuds and focus his considerable intellect on advancing, furthering the mission of the Federal Reserve. That's the same kind of professionalism that Dr. Johnson has demonstrated in his earlier performance at the Treasury Department. There he won the department's highest honor, an award known as the Alexander Hamilton Award. While at the Treasury as Assistant Secretary, he had a major role in formulating United States economic policy. Dr. Johnson holds a doctorate in economics. He's a university professor of economics, and he's written 4 books and over 50 articles on political economy and public policy. Certainly the time could not be more appropriate, nor the man more appropriate than Dr. Manuel Johnson.
Thank you very much, Arthur. It's my pleasure to be here today. I realize from your perspective the timing is appropriate. I'm not sure from my viewpoint I picked the perfect time to be here today, but I think in a way I really have. Maybe this is the most convenient time for me to address this group at a time when there seems to be some volatility in the stock markets and some concern, because I think it's important to try and point out some of the economic fundamentals that exist in the free trading system and the U.S. economy in particular today, and try and see if we can't focus on those issues and avoid some of the current uneasiness with animal spirits in the markets. And I think that's a good place to start. I think really, in terms of talking about the economy, we should briefly look at the situation in some historical perspective before talking about the implications of current issues. And I think the first thing that comes to mind when you look at the performance of the U.S. economy over the last 5 years is that the economy indeed has expanded uninterrupted for 5 years, about to enter its 6th year of economic expansion, and that this is now the longest peacetime expansion in the post-war era, and I think you can go back a good deal further than that. In addition to that, and I think the other very interesting fact about current economic issues is that not only is this the longest peacetime expansion, but even in spite of what's been happening recently, inflation rate and interest rates are as low or lower today than they were when this recovery began at the end of 1982. Most of you may find that unusual, but that's still a fact, that interest rates and inflation rates are generally as low or lower today than when this expansion began. And that is also a very unusual event that's really unprecedented in post-war expansions. Now, I don't want to sit here and say, though, that the economic situation doesn't have its risk. But I think it's important to point out some of these fundamental strengths. And I think that this does point out that the future course of the economy has great potential, that given these fundamental facts that, that inflationary pressures seem to be modest, and that interest rates, even though they have gone up recently, are still lower than when the expansion began, indicates that there is still quite a bit of strength, fundamental strength to the economy, and that, that the free trading system has the opportunity to continue expanding for some time without destabilizing forces taking place. Now, as I said, this situation is not without its risk, of course, and I think that there are some obvious issues that you're all well aware of that have to be addressed and ultimately dealt with if we're going to continue to have an economic expansion without financial instability and inflationary problems. And those obvious issues are associated primarily with the U.S. federal budget deficit and our deficit in trade and the associated surpluses in the industrial, among the industrial trading partners. So indeed, there are these international imbalances of large trade deficit in the United States and equally large trade surpluses among its industrial trading partners, and a very large federal budget deficit still to be addressed. But I should point out, though, that progress is even being made there. I think we shouldn't lose sight of some of the progress that's been made in this particular area. I think one of the concerns, of course, about such large imbalances in the free trading system is, though, that with the U.S. running a significant federal budget deficit and requiring a substantial amount of private savings for its financing, as well as trying to continue to have an investment expansion at the same time, requires a continuation of net capital inflows from abroad because our domestic savings is not at a level to satisfy both domestic investment and government consumption, and therefore there is a need for capital imports from abroad. And as long as that's the case, there has to be the other side of the coin, which is a current account deficit. And so as long as we are reliant on foreign sources of capital flows to sustain the domestic economy as well as government consumption, there will be a persistent trade deficit and a growing external debt. But as I mentioned a minute ago, I think that's the major concern. But as I mentioned a minute ago, I think that we have to focus on some of the gains that have been made in this area and realize that we have made a good deal of progress and that we roughly have these imbalances moving in the right direction, and the economy is generally on the right track. Let me point out that, that just during this last fiscal year, that the U.S. federal budget deficit has come down between $60 and $70 billion from its peak level of $221 billion in fiscal 1986. This is a dramatic turnaround in the federal budget deficit, equal to about 1.5 to 1.6% of gross national product, which is an exceptional change in the direction of federal spending as a percent of GNP and as an absolute amount. And this has taken place with no basic improvement in the nominal current account deficit at this point. In other words, we're still receiving into the U.S. basically the same net capital inflow as before, and on top of that we've had roughly a $60 to $70 billion reduction in the federal budget deficit. In other words, we've had a $60 to $70 billion reduction in government's demands on private saving, both domestically and from abroad, so that there has been an increased capacity for private domestic investment through some of the relief in the direction of the federal budget deficit. And I think that this needs to be pointed out. In addition to that, the Congress passed and the President signed an additional amended version of the Graham-Rudman-Hollings amendment, and this will require an additional $23 billion in either budget reduction or spending reduction specifically, depending on how the budget priorities get resolved in this Congress. But In fact, they did, the Congress and the President did renew the sequestration process by making it constitutional through allowing OMB to be the sequestering agency. And in fact, now there is a stronger discipline on the domestic spending picture, because if budget priorities aren't sorted out by sometime in November, there will be an automatic sequestering across the board of federal expenditures equally between defense and non-defense spending on the order of about $23 billion for fiscal 1988. This will continue to move the federal budget deficit in a direction, I think, that shows continued improvement, should continue to reduce the deficit as a percent of GNP and in absolute amounts. And so I think it's important to point out the progress that's been made over the last 2 fiscal years in trying to deal with this particular problem. Now, on the external debt and the trade deficit, I think it's important to point out that progress has also been made. As I mentioned, you cannot see a turn yet in the current account, overall current account deficit, although the last month's numbers were slightly lower for August than in July. Some analysts were a little disappointed with the degree of improvement, and there's been some nervousness in the financial markets over this particular issue. But I should point out that significant progress in the federal trade deficit is underway. In real terms, volume terms of trade, the U.S. trade deficit has improved by up to $30 billion in real terms since the third quarter of 1986. And in fact, the improvement in real net exports has contributed roughly 1/3 of the real GNP growth rate that we've enjoyed over the last 3 quarters in the U.S. economy. So in fact, trade is turning in a positive direction that is supporting real growth rather than putting a drag on the performance of the U.S. economy. And I think this is an important event. Now, in spite of that improvement in the real volume of trade, we still haven't seen any major improvement in the nominal current account deficit. And I think one of the reasons for this is that it takes a while for contracts to be renegotiated at the changed prices, so that in fact you get larger volumes under old contract prices, which temporarily intensifies the nominal trade account before it gets better. And of course, this is known as the J-curve effect, where first you see an improvement in real terms in the volume of trade before you see an improvement in the actual amount that you have to finance, which is the nominal current account. But of course, we have seen the current account peak out over recent months and not increase in size. In addition to that, I think if you were to subtract, the data show that if you were to subtract out all imports, that you would find that the nominal current account has actually been improving too in the areas of non-oil trade. In fact, the bilateral trade balance has been showing some improvement between the 2 major surplus countries, between Germany and Japan. So part of the problem is that the recent rise in oil prices back from the $10 to the $20 range has masked what would have been an improvement by now in the nominal current account deficit, and I think this shouldn't go unrecognized. Because of this, I think, temporary effect of the oil price on oil import values, you haven't seen this improvement, but in fact the Federal Reserve is forecasting a fairly significant improvement in the nominal current account for 1988 and a continued improvement in real terms on the order of what we've already seen. So I think that even in terms of the trade imbalance situation, we are moving generally in the right directions. These imbalances are coming down both in the domestic budget and in the external debt situation. And so the stage, I think, is being set for a healthy continued expansion without inflationary instability. However, there are still other questions, and I think because of these imbalances, about the future course of economic policy in the U.S. And maybe this is one of the sources of financial uncertainty that permeates the market today and has led to some of the troublesome volatility that we've seen. I think a significant question in the financial markets is actually how policy is going to deal with these imbalances in the future, and what direction economic policy will in fact take, and will the direction of policy in terms of fiscal and regulatory policy put the Federal Reserve in a tight box that makes our decisions more difficult, and has to make tough decisions about inflationary instability that would otherwise not have to make. And I think that's some of the concern that may be in the financial markets today. And so it matters how we continue to try and resolve these imbalances. And I think that one of the things that we don't need to see in the future are quick fix solutions to the trade imbalance, for instance, or for that matter, in the federal budget deficit. The last thing we need is, in today's environment, is a quick fix approach to the federal trade deficit by, say, trying to artificially depress the dollar severely below current levels. This would simply, I think, exacerbate financial market conditions and lead to further potential for financial problems. And in fact, I think that we already have a depreciation in the dollar that is underlying the improvement we're seeing in the trade deficit at this point. The dollar has declined from its peak levels in early 1985 by about 40 to 50% against the major industrial countries' currencies. At the Federal Reserve, we're not hearing any industry representatives over the 12 districts of the Federal Reserve that are saying today that they can't compete at roughly this level of exchange rates. In fact, we're seeing strong pickups, strong improvement in orders for export and for import substitution type products. So, in fact, we are getting the recovery in trade that we've been looking for. And you can see it in looking at the sectors associated with trade-sensitive areas. So the exchange rate, I think, has already made an adjustment that brings U.S. industry roughly to competitive levels. This is one reason why I think it's kind of interesting that there's been so much stock market volatility, because I think the adjustment that we've seen to this date would indicate that the earnings in these categories and trade-sensitive sectors is going to be quite strong over the months to come. And so economic performance, I think, should be quite strong in the trade-sensitive sectors of the economy. But I think, as I mentioned, what we don't need at this point, after we've had a 40 to 50% adjustment in the exchange rate against the other major industrial countries' currencies, is to try and depress the dollar dramatically from this level on. I think that what we have begun to see in the recent past is that the dollar, in many cases, the dollar's easing from these levels in many cases has been symptomatic of inflationary expectations. And because of this, of course, the Federal Reserve has sought to try and deal with these rising inflationary expectations by tightening policy twice since the spring, once in the April-May period and once in September with an increase in a half point in the discount rate. But since that time, we have not seen the type of inflationary expectation increases that we had been observing up until the time when we increased the discount rate in September. So I think, though, that we have to be observant that further depreciation in the exchange rate, if it appears symptomatic of rising inflationary expectations, could be a problem, and that trying to artificially depress it to deal with our trade imbalances would be, I think, counterproductive. But it's also true that there are some qualifications that need to be made about the exchange rate. First, there are times when the exchange rate is symptomatic of inflationary expectations, and there may be other times when it's not. A good example of a period when a decline in the dollar was not symptomatic of inflationary pressures was during most of 1986. During 1986, we saw a significant depreciation of the dollar, but that depreciation of the dollar was also consistent with continual rally in the bond markets strength in the stock markets, and in fact a decline in long-term interest rates during that entire period. So that depreciating dollar during 1986 was not a signal of inflationary expectations. Indeed, it was a period when the federal budget deficit was coming down sharply and oil prices were also falling. So that the fundamentals in terms of the improvement in the inflation outlook overwhelmed any adjustment in the exchange rate. So I don't think movements in the exchange rate in both the bond markets and movements in broader commodity prices and inflationary and the broader inflationary indexes to see whether it's also consistent. Movements in exchange rates are also consistent with inflationary expectations. And I think that that what we had seen during our periods when we had tightened previously was a consistent picture in that direction. That inflationary expectations were building not only through signified by some weakness in the dollar exchange rate, but in sharp movements in upward movements in broad indexes of commodities and in some of the broader inflation indexes, as well as in a sharp steepening in the interest rate yield curve. Since our moves to moderate inflationary expectations with our tightening policies, we have seen these expectational forces settle down some. We have seen the yield curve up until just the last few days start to flatten out. Most recently, I think we've seen Treasury bill rates fall relative to the long end of the market, mainly due to some flight to quality recently, and this is, I think, somewhat artificially depressed the short end of the Treasury bill market. But in fact, up until recently, we have seen a flattening in the Treasury yield curve. We have seen the modification of commodity prices and the broader inflation indexes. And Chairman Greenspan has recently said that looking at the fundamentals on the inflation side, that the data don't actually appear representative of any further upward movements in inflationary pressures. And so we have seen the kind of expectational forces develop, I think, that we've been satisfied with since our last discount rate move, and we've maintained a steady monetary policy. But once again, one of the other issues I think that we have to try and avoid, as well as trying to pursue quick fix solutions through dramatic reductions in the exchange rate, when in fact we're already competitive at this level of exchange rates, and further sharp declines would simply be troubling to the financial markets, I think, and raise concerns about inflationary expectations. We also have to worry about quick fix solutions through the protectionist trade route. And I think we get to the same basic result in that direction. If we tried to depress imports artificially into the U.S. market by serious trade protection legislation that would cut off the flow of imports in the U.S. economy, you would have a tremendous restriction in the flow of foreign capital into the U.S. to support the financing of imports, and you would see sharp drops in the dollar and financial instability in the same way that you would if you tried to depress the dollar artificially from the beginning. And so these are approaches that we have to avoid. We have to avoid protectionist trade legislation. We have to avoid attempts to artificially depress the dollar if we're going to make the transition to a continued expansion without inflationary pressures and financial instability. And I think that that's the direction we have to seek, and that's the direction that puts monetary policy at ease and avoids some of the tough decisions that the Federal Reserve would have to make otherwise. I want to point out also on the exchange rate, in conclusion, that there's one other source, I think, of potential exchange rate weakness that wouldn't necessarily imply inflationary expectations. I've already mentioned the fact that oil price movements and other fundamentals that allow some dollar depreciation without a concern of inflationary expectations feeding into the bond market. There's also the potential for foreign central banks to over-tighten monetary policy in a way that would raise interest rates abroad and attract capital but not have the same significance for domestic inflation in the U.S. economy that might otherwise take place if monetary policy were too easy in the United States. So I think you have to be careful to determine what's the cause of dollar depreciation. Is it because of rising inflationary expectations in the domestic economy, or is it because overly tight central bank policies abroad, or is it because of sharply declining oil prices or some other fundamental movement? It's very important what the source of those exchange rate developments is in terms of its implications for inflationary expectations. So on a final note, I think I've tried to point out the strengths and the fundamentals in the economy and what needs to be done to further improve those fundamentals by dealing with the two major risk factors in the economy today, the large federal budget deficit and the trade imbalance that we face. But there's a way to proceed and a way not to proceed, and I think that we have a great opportunity to continue a stable expansion without inflationary pressures if we move in the direction that we've moved in the recent past by continuing to work down the federal budget deficit, by trying to improve our structural, improve the structural factors in the economy like productivity improvements, rather than trying to artificially depress the exchange rate to solve our problems from this level. We've gotten a reasonable exchange rate adjustment that's allowing our industries to compete without stimulating inflationary pressures. But from this point on, I think we have to be careful about where we go with exchange rate policy, and it's very important how we resolve our trade imbalances from here on. There are no quick fix solutions to this. We have to take on these issues in a systematic way and in a stable way, and I think if we move in that direction, monetary policy will be able to support the expansion without having to deal with inflationary pressures. Thank you very much. I promise to take some questions at this point. I should start off by saying, before I take any questions, that I want to avoid talking about any questions directly associated with current monetary policy. I know that may preclude a lot of my questions, but I don't think this is an appropriate time to be talking about specific monetary policy, but any other questions I'll be happy to entertain. Yes, sir.
I think around the world, everybody is making business in dollars. So at the end, in a way or another, they need dollars. And if you had not a deficit, a trade deficit, the world could have a shortage of dollars, and you could have a corner in the market. So don't you think that instead of seeing the trade deficit as a problem for the free world, it is in fact a good thing for us to have you in deficit and supplying the world with dollars?
Well, I think one of the points that I was trying to make about not seeking quick fix solutions to the trade deficit problem was that, in fact, the United States is a world reserve currency. The U.S. dollar is a world reserve currency. The United States has always been a key currency country, and much of international trade is conducted in dollar-denominated terms. And so because of this key currency status of the United States, there is an exceptional demand for dollars that wouldn't otherwise be the case. And therefore, because much of international trade is dollar-denominated and there is a strong demand for dollars, we're going to see net capital inflows into the United States, at least for a reasonable future. And so because of this, we don't want to disrupt that flow of transactions by trying to solve our trade deficit problems overnight. We can, as I mentioned, trying to eliminate the trade deficit in a very short time risk a substantial outflow of foreign capital and a disruption of trade that is highly denominated in dollar values, and would make it very difficult for the financial markets. And so I think the point is that we have to use our common sense about dealing with this problem. I don't think that we want to continue to persistently run a trade deficit on an indefinite basis, But I think that over the intermediate term, what we need to worry about is getting the trade deficit down to a level that makes it internationally financeable, rather than trying to simply erase it overnight, because we do depend substantially on foreign capital flows into the domestic market for the reasons that I've already mentioned, and trying to disrupt that flow of capital, I think, would be very unfortunate. And so what we need to do is gradually work down the trade deficit. We've already had an adjustment in the exchange rate. I think it's starting us on that course in a stable fashion, but further sharp reductions in the exchange rate, I think, would be unfortunate in that direction. And so now I think we have to see how much adjustment takes place at this level of exchange rates and avoid quick fix solutions, because the capital flow disruptions could be important. Yes, sir.
The spirit of the G7 Accord is still in place. What moves would you like to see some of the member countries make? Repeat the question.
The question was, he assumes the spirit of the G7 Accord is still in place, and what changes would I like to see to that accord, I guess, for future, in terms of current developments? Is that it? Okay. First of all, I think that's right. The spirit of the G7 Accord still is in place. And in fact, as I speak, the exchange rate has maintained much of its stability. There has been some depreciation of the dollar against the Deutschmark, but against the yen and most of the other industrial country currencies, the dollar has been quite stable. In fact, most people don't realize that there's really been no net dollar depreciation against the 10 major industrial country currencies in 1987. In fact, the Louvre Accord has worked very well in terms of stabilizing exchange rates. And I think that that spirit still remains. But I think that there is some discussion about who does what within that accord, and whose turn it is to make a move in terms of stabilizing exchange rates in order to avoid any sharp exchange rate moves. And I think there have been some recent discussions, of course, between the U.S., I guess, and West Germany about their need for tighter policies and higher interest rates in a period when their economy doesn't show strong signs of growth and no rise in inflation. And is it necessary to narrow interest differentials in an environment like that? And I think that this gets back to one of the points that I made earlier, is that the inflationary significance of the exchange rate depends on whether the exchange rate, an exchange rate weakness is symptomatic of too easy a monetary policy in the U.S., which may be supporting a rise in inflationary expectations, versus too tight a monetary policy maybe abroad that might be strengthening the value of some foreign country's currency relative to the U.S. dollar. Those have totally different implications in terms of their inflationary potential. And I think if the parties can sort out these differences, that the spirit of the Louvre Accord will remain. Of course, it's desirable, I think, to have it remain and maintain rough stability in exchange rates, barring any external shocks to the system. But once again, it's important to have an understanding of who does what in that system if we're going to maintain stability in exchange rates.
Caution against the effect of protectionist types of developments and the effect it'll have with our trading partners and so forth, and advocate continued budgetary restraint in reducing the budget deficit. Yet the Pentagon just released a report last Friday which said that if the Gramm-Rudman sequester goes into effect, it'll cut the defense budget by $35.5 billion. And that could have just as severe an effect with regard to our relations to our allies, not only militarily but also economically, as problems with regard to trade directly. How do you respond to that?
Well, I respond to that to start with by simply saying that I'm not a defense expert. And as someone focused mainly on monetary policy and overall economic policies as well, I can't really comment on the significance of any particular budget reduction in the defense area. I think that's for some other person to try and address. But I think it's important to point out, though, that the reduction in the budget deficit of the $23 billion that I mentioned is significant and important. I don't know, I'm no expert on the issues between budget priorities, whether it comes out of domestic or defense, but I simply can say that reducing the rate of growth of federal spending by $23 billion annually can't be all bad. That's got to be a good thing.
The declaration about selling of gold was going up higher than a sudden price. Can you comment about that, if I'm right, about the declaration you made to French newspapers?
Yes, I think there was a report in the French newspapers that I had made a comment about the Federal Reserve targeting the price of gold. But my only reference was that the price of gold, like commodity prices and bond yields and the exchange rate, had all been roughly stable since our last discount rate move, and that the gold price is one thing we look at the Fed, as well as commodity prices, exchange rates, and bond yields, among many other things, and that I was pointing out the rough stability in its price, but it has no, that comment had no significance in terms of targeting the gold price. Of course, we're not. We're only looking at prices of commodities as leading indicators of price expectations, among many other variables. Yes, sir.
As I understood, you agree with Baker on the German monetary policy, but you don't agree on the solution that Baker proposed for it. But what other solution do you see? Because it seems that the G7 is not working well in the respect of central banks advising each other on what they were going to do.
Well, I think the question was that the G7 agreement doesn't appear to be working that well on the basis of who does what, and whether I supported Secretary Baker's recent recommendations about what maybe revaluing currencies to some extent. First of all, I think I'd point out that I don't think the G7 has worked that badly. As a matter of fact, I think rough stability in exchange rates during 1987 has not been a bad record at all. I think it has worked very well. But I think the point is that recently there have been, I think, some disagreements over the direction of relative domestic policies in trying to stabilize exchange rates. And I think that what's going on is a normal process of trying to coordinate policy and reach an understanding. But as I said, this still has not produced changes in exchange rates that are outside the broad ranges of the G7 agreement.
Would you say that at some point the markets listen to the Fed, and at the moment the markets are trying the Fed to listen to them?
The question was is the Fed listening to the markets? The markets seem to be trying to speak, and are we paying attention? I think that was sort of the question. Well, of course we're paying attention. As a matter of fact, I think market signals are very important for monetary policy. But as I pointed out, I have not seen anything inconsistent in what's going on in the financial markets with stability and inflationary expectations. I think there was a period in the spring and early summer when we were seeing some signs of rising inflationary forces. And of course this has justified the moves that we made up until that time. Since then, I think we've seen some of the surveys of inflationary expectations actually come down. I think Mr. Hoy's survey at Drexel Burnham of Wall Street executives on inflationary expectations has dropped recently from previous levels. We have not seen sharp increases in commodity prices nor in the broader inflationary indexes. Labor cost, unit labor costs are still well under control and show no signs of sharply intensifying in terms of upward pressure. The fundamentals very well. We have seen recent pressures in the broader indexes of inflation from the recent rise in oil prices earlier from the $10 to $20 billion range, and there's still some feeding through going on of the previous adjustment down the dollar exchange rate. But as I mentioned, we've had rough stability in exchange rates during this year. And so we don't expect to see further feeding through after this wears off of rising price pressures due to exchange rate movements. As I said, we've had 10 months now of roughly stable exchange rates. And this will, I think, begin to show through in declining inflationary expectations, as well as the fact that oil prices have stopped their rise and show some signs of coming down some. Of course, there are always tensions in the Mideast, and we're obvious of those today, that may cause that to fluctuate. But we are watching the markets. I think that, in fact, there appears to be a large risk premium in the markets these days over uncertainty about some of these questions I've raised today. But I don't think it's inflationary expectations. At least the evidence is not consistent with what we'd seen earlier on inflationary pressure. And so I think you have to look elsewhere for your evidence. I think Mr. Levitt has pointed out that my time is up, and so thank you very much.
We will continue with more from the American Stock Exchange Washington Conference in just a few minutes, with the remarks of the chairman of the Securities and Exchange Commission.